Today we're looking at 4 stocks, count them 1, 2, 3, 4, that you should be watching to potentially buy right now. I'm willing to bet that you probably haven't heard of at least one of these before because we've got a restaurant stock, a blue chip, a very exciting ETF, and a space stock. No, it's not Virgin Galactic. Let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today we're talking about 4 stocks to watch and potentially buy right now. Now, full disclosure, I do own all 4 of these stocks. Whenever I do one of these videos, I try and throw in at least one stock that I think most people haven't heard of before, so why not just start with that one? Stock number 1, MAXR Technologies, ticker symbol MAXR. MAXR Technologies is an aerospace and defense company leading in Earth intelligence and space infrastructure, and I think it's got some very exciting comeback potential, especially with a new acquisition that they just announced. But more on that later. Let me start off by saying that this is a very risky, more speculative play, okay? Most of the other stocks in this list are going to be relatively steady, safe stocks, but this one's going to be a bit more controversial. So I always tell you guys to do your own due diligence, but with this one, please do that. Alright, so MAXR is a company that specializes in satellite technology for Earth observation, radar, communications technology, and much more. They're also considered an aerospace defense company because a lot of their services and products have military uses as well. It is for that reason that many of their customers are government agencies like NASA, the Army, the Air Force, etc. But they also have contracts with big commercial giants that include Boeing, Google, Amazon, GM, Lockheed, and more. A lot of these commercial contracts are more for things like 5G and the Internet of Things. So I want to talk about an acquisition that MAXR is going to make, and it's very promising, but before we do that, we have to take a look at their financials and just get that out of the way because I'll be honest, they're butt ugly. Before we jump into the balance sheet, this is their revenue breakdown, just to give you a better idea of what their business is about. They've got about 60% of their revenues coming from Earth intelligence, which is like geodata and satellite imagery, and 40% is from space infrastructure like satellites. Alright, moving to the balance sheet. They had a net loss of $48 million in Q1, which is never good, but it is better than a year ago. And about $16 million of that was due to the Roners, and another $14 million was due to a satellite anomaly. So under normal circumstances, we would have seen a loss of $18 million, which is actually a huge improvement from a year ago. They only have $12 million in cash, a significant drop from last year, but much of that can be attributed to their efforts to paying off existing debts. On the bright side, with about $1 billion in current assets and $830 million in current liabilities, they have a current ratio of 1.2. And remember, current ratio tells us the health of their financials for the upcoming year, and we usually want it to be above 1. And although their financials aren't that great today, they do have a long-term plan to turn things around that focuses on delevering and reducing their debt and increasing top-line growth. Part of that plan is their acquisition of Vricon. MAXR is exercising their right to take full control of Vricon, which is another Earth visualization company that provides extremely accurate 3D models of the world through satellites. Vricon also has many military defense uses, and they also boast the world's largest satellite imagery archive. This acquisition will also help MAXR get a better foothold in the 5G network planning industry. Lastly, this acquisition will not actually have that much of an effect on MAXR's debt, which is fantastic, and they expect Vricon to be a great cash generator for their business moving forward. And the last thing about MAXR before we move on to our other 3 stocks is their PE ratio, which looks pretty attractive when compared to other people in the industry. For example, Lockheed Martin has a PE of over 16, and Northrop Grumman Corp has a PE of over 23. And of course, it's also reassuring, in fact, very reassuring, that Michael Burry, the big short guy, has a sizable position in MAXR as well, and we all know what he's capable of. Stock number 2 is The Cheesecake Factory, ticker symbol CAKE. I swear I wrote this script before the 12% jump on Monday. I hate when that happens, when I have this script ready and I'm like, go check this out, and then it has this huge pop before the video comes out. But you know what? I don't think it's too late. For the sake of simplicity, we're just going to call this one Cake or The Cake from now on for the rest of this video. And I know what you're thinking.
Matt, you just got this from Jeremy in Financial Education.
Yes, I did. He was certainly the one who put me on the trail. I think he made a great case for this one, but as independent investors, we always want to do our own due diligence, so here is mine. The 3 things I want to briefly cover for Cake are 1, their response and how they're handling this pandemic. 2, how they're always outperforming the rest of their industry. And 3, their diverse business opportunities beyond just the Cheesecake Factory chain. Let's start off with their off-premise sales numbers, in other words, their online deliveries or pickup orders and stuff like that, because obviously that's what's going to be keeping them afloat for now. So I sat down and read pretty much this entire Q1 conference call transcript just for you guys. And I learned a lot. For instance, Cake's strategic team has some big brains. For example, once the Rona hit, Cake knew they had to find a way to differentiate themselves from the competition during this pandemic. So what do? They immediately renegotiated their deal with DoorDash so that it would make more economic sense for them and also so that it would improve their marketing. And by marketing, I mean Cake was able to get DoorDash to place them in preferential positioning if you're within the radius of their restaurant. In other words, they're more likely to show up at the top of your app if you're in the delivery radius of one of their restaurants. And there's proof it's working too. Through DoorDash, the Cake has seen a high growth in new customers that had not dined at Cheesecake Factory before, and many of these new guests are reordering. In their Q1 conference call, the CEO also said that as they begin to reopen on a bigger scale, Cake is uniquely positioned with their restaurant layout, which allows for social distancing while producing enough dine-in sales volume to be meaningful. And you can see what he's talking about here. I've got a Cheesecake Factory right by my house, and I can tell you the insides of these places look like a palace sometimes. So I think this statement is pretty true and pretty unique to Cake. Their extravagant layout means a lot of people can be inside the restaurant at once while socially distanced and producing a lot of sales volume. And I think this consistently smart and strategic way of thinking by the executive team can be very well illustrated and reflected in this. This is a chart showing how the Cake consistently outperforms their competitors in the broader restaurant industry. Literally every single year, they outperform. This is the Great Recession, and the maroonish color is Cake's performance, which had much better numbers and much faster rebounds than most restaurants. Yet, despite this, when you compare Cake's stock performance to the rest of its peers like Cracker Barrel, BJ's, Red Robin, and Brinker International, Cake's stock is actually underperforming the other guys when history shows their business is probably outperforming right now. So you can draw your own conclusions from that, but to me, it looks like the market has it wrong. And finally, the Cheesecake Factory is a lot more than just the Cheesecake Factory. Cake also has their hand in a chain called North Italia and an incubation engine called Fox Restaurant Concepts, or FRC. North Italia is an up-and-coming themed restaurant that currently has 23 locations in 11 states, and Cake plans on rolling out 200 of these locations over time, which obviously sounds promising. They also have an incubation engine, which is basically a way for Cake to try out a bunch of different restaurant concepts all at the same time and pick and choose which ones they think are going to be big winners and develop into bigger chains. Their incubation engine goes by the name of Fox Restaurant Concepts, and they've already picked a few restaurants for potential growth and display several boutique brands. And this is important to know because it shows there's a lot more different ways and opportunities for Cake to grow beyond just the Cheesecake Factory. There are, however, some rough parts and some risky risks. Their financials aren't the prettiest. They have been increasing their cash position consistently over the past few years, but their current ratio, with $270 million in current assets and $507 million in current liabilities, is a rough 0.53, and we usually want that to be above 1. However, it is important to note that this is not uncommon in the restaurant industry. Darden, which owns names like Olive Garden, has a current ratio of 0.43, even worse. Additionally, $161 million of Cake's current $507 million in current liabilities is from something called gift card liabilities, which is a type of deferred revenue. This just means that when a gift card is sold, Cake technically can't record that as revenue yet because they're obligated to deliver a service or food in the future for that gift card. So in my opinion, this isn't something I'd be too worried about. In fact, I think it's a lot better than something like long-term debt or short-term debt. And of course, the other worry is a resurgence of the Roners, but as we've already seen, Cake is taking the necessary steps to stay afloat and do well in off-premise sales. Stock number 3, or ETF I should say, is ARK Innovation ETF, ticker ARKK. This ETF focuses on cutting-edge technology and companies that are on the forefront of innovation. They have $2 billion worth of assets under management with about 35 to 40 holdings at any given time, and they invest across a wide range of market caps as well. This fund is rooted more in the growth concept and not so much your typical value investing ideals. But this doesn't mean they're just taking shots in the dark. In fact, they do very, very extensive research into these speculative, kind of dangerous, but also very interesting, but a little risky, but super cool investments. As I like to say nowadays, the proof is in the portfolio. As you can see from their performance since inception in 2014, they have significantly outperformed the S&P in the last 6 years. As of June 26, 2020, they have 37 positions, and their top positions are Tesla, Invitae, Square, CRISPR, and Roku. Let's give you a little taste or a little insight into what their holdings are like. Tesla is obviously Tesla, and ARK is famous for their multi-$1,000 price target on Elon's empire. Invitae, I think I'm saying that right, is genetic testing for a variety of medical conditions. Square is trying to disrupt the banking industry. Go watch my video on that one right here. CRISPR is gene therapy, and Roku is a play on the streaming wars. These are all very innovative, and some could arguably be considered speculative, but that's what this fund is all about. And lastly, you always want to know what leadership is like in any of your investments, so who is leading ARK Invest? That would be Catherine Wood, the CEO and CIO, Chief Investment Officer for ARK. She has over 40 years of experience in identifying and investing in innovation. She obviously has a ton of experience in this field, and I can go more in depth into that, but I think it's a little too much for this video. At one point, she was managing over $5 billion, just know that, and whatever she's doing at ARK is obviously working well. I like ARK a lot because it allows me to invest in a range of different high growth opportunities that I would like to invest in individually, but I can't invest in 37 different positions in my own portfolio, so ARK does that for me, and I want to be a part of it. Finally, stock number 4, and you had to know this one was going to be on the list, Facebook, ticker symbol FB. And before you click away and be like, oh, Facebook is so obvious, let me drop some knowledge on you, please. When I was writing this script, much like with the cake situation, Facebook was trading much lower at around $210. I don't know, maybe it's there now when you're seeing this video. But it was after the 8% drop in one day, and that was easily a buying opportunity in my opinion, and I added to my position, and here is why I made that decision. Yes, all these headlines saying big companies are pulling their ads from Facebook, oh, Facebook boycott, scary headline, sell your shares. No. If you just do a little bit of digging, you will realize that the top 100 brands that spend the most money on Facebook advertising last year only account for 6% of Facebook's ad revenue. In other words, this means that if you took the 100 brands that spent the most money on Facebook last year, all of them, and they all just stopped advertising for all of 2019, Facebook would only lose 6% of their ad revenue. Not to mention all their other streams of revenue. Additionally, if you take that list of 100 top advertisers on Facebook and go to the very tippy top, that would include the likes of Home Depot, Walmart, Microsoft, and AT&T, most of which are not part of the boycott, at least not yet. The majority of Facebook's ad revenue is from small to medium-sized businesses, and it would take tens of thousands of these small businesses to also boycott Facebook over a significant period of time to even make a dent. And need I remind you that Facebook was slapped with a $5 billion fine, and if you look at their 5-year chart, it pretty much just follows this red line, and in the end, it just keeps going up. That boycott right now is not even close to reaching $5 billion in lost ad revenue. In fact, if you took those 100 top advertisers on Facebook and totaled it all up, it would come to about $4.2 billion in 2019, which is, yes, less than $5 billion. So that's why I see all this negative press about Facebook as a very good buying opportunity. Did the fundamentals change? No. Do they still have one of the best balance sheets in the world? Yes. And don't forget about their other catalysts like Facebook Shops, which is going to be on Facebook and Instagram, where they have over 1 billion monthly active users on Instagram. Additionally, Facebook Shops has the superpower of suggesting things you would want to buy because guess who has all your data? Facebook. They have another 3 billion eyeballs on other platforms that they own like WhatsApp, just waiting and begging to be monetized. They have Libra, which is still a conceptual and very in-the-works project, but it has a lot of promise and shows that Facebook is diversifying revenue streams. And Facebook Gaming just got the white flag raised by Microsoft's MAXR, which means not only did a competitor just drop out of the race, but now they're just going to get stronger in a growing industry that is gaming. Need I say more? Watch for any more dips on Facebook because of this news, because honestly, I think in the long term, it is a great buying opportunity. If you found any value in this video at all, and I hope you did, please make sure to hit that like button, subscribe, and check out this quote of the day because you might learn something from it. Follow me on Instagram for daily posts about my portfolio, stocks I'm watching, news, and all that good stuff. And of course, thank you so much for watching to this point in the video. You are the real MVPs. Don't forget your peace and thank yous.